So I'm going to bring Al in now. Hello, Alan. Good to see you.
Hey, Richard. Good seeing you. Hi, everyone. I'm Al Brooks, and I'd like to spend a few minutes telling you how I use my Encyclopedia of Chart Patterns. Back in the 1980s and 90s, I spent about 10,000 hours backtesting all kinds of ideas. I wanted to create categories of chart patterns that hopefully would be fairly reliable. And I came up with about 100 patterns for the bulls, 100 patterns for the bears. And then each pattern can fail, so you multiply times 2, and I have about 400 categories. You don't have to learn all 400 types of patterns and their variations, but if you learn a handful of them and you get very good at them, you're then in a pretty good position to make some money as a trader. I made my collection available online several years ago, and I'm going to talk a little bit now about how I use it. As you watch a day unfold, you try to figure out what's going on, and every bar gives you additional information. And based upon what you're seeing, you're changing your opinion about what the market might do. So here we have a double bottom. It failed to create a reversal. We had a third leg down and then a reversal from a higher low double bottom. So this is a wedge sell-off to a higher low double bottom. A bad buy signal bar, but then a pretty good bull bar here. It's a reasonable buy betting for a swing up. Always assume that what is happening on the open is a test of some kind of support or resistance, even if you don't see that support or resistance. And the initial move can be the exact opposite of what the eventual trend will be. The market makes strong moves on the open. Half the time, the strong moves lead to a swing, and half the time, the strong moves reverse, and you get a swing in the opposite direction. So don't get too excited about a breakout early in the day. Only trade it if it continues to have follow through. If you get a reversal, bet on the opposite direction. If you're trading and you see a pattern and you're pretty familiar with it, then go ahead and place a trade. But if you're not all that comfortable with what you're seeing, you can turn to this encyclopedia to find similar patterns. So first of all, you have to decide what you're seeing. Here we have a reversal up with small bodies and prominent tails and a small pullback. After a bear trap, the market tried to go down and it's reversing up. This could be the start of a small pullback bull trend. It's a gap down below the moving average, probably below yesterday's close. So if you're uncomfortable with what's going on, you can look in the encyclopedia in the section about gap downs and reversals up, or in the section on bull trends from the open, or on the section of small pullback bull trends, and try to find something that looks similar to this. And if you find several days that have patterns similar to this, then you take a reasonable bet that what will follow today will be like what followed on those other days. Here we had a rally. We had 3 attempts down, 1, 2, and 3, a wedge top. But in a small pullback bull trend, it's probably a minor reversal. This is a double bottom with this low, but a bad buy signal bar. It's a lower low, so a little bit weaker, and it follows a fairly big bear bar. This is probably a minor reversal. So it looks like today is going to be a trading range day. When you look at the encyclopedia, and you'll see things that look like this, a lot of them will look like this for the rest of the day. And that will give you confidence to take shorts up here, despite the small pullback bull trend. And it will give you confidence to bet that the reversals down will be minor, so you look to buy a reversal back up. You look for bull bars closing near their highs. Here we have a couple. You can buy on a stop above the high of that bar and get long there for a swing up at the end of the day. You have to constantly reevaluate what's going on. The bulls and bears are always fighting, and they're trying to control the market. They're trying to change the direction and trying to get the direction to go their way a long time. But you have to be quick to exit, even with a loss, if you decide that the premise of the trade that you took is no longer valid. If so, look for a trade in the new direction. And if there's good evidence that your premise is now again good, you can enter again in your original direction. This is an FOMC announcement. I don't have the bars at the beginning of the day because they're not necessary to illustrate the point. But here we have a very strong bear breakout and some bear follow through, but tail here, a bigger tail here, a low one sell signal with a bull bar. So we're getting buying, and a bad sell signal, and then more tails. So we may reverse from a double bottom. You look at the sections on FOMC announcements. I have sections for every type of thing that can happen after an FOMC announcement, and you're going to be thinking about a bear breakout that will fail and reverse up, and you're looking to buy above a bull bar closing near its high for a swing up. Always trade a small size, at least until you're consistently profitable. Try not to constantly reverse on minor reversals. So if the market is doing this, instead of buying and selling and buying and selling and buying and selling and buying, you're going to lose a lot of money. When the market is in a fairly tight trading range with small bodies and prominent tails and a lot of overlapping bars, it's better to do nothing. Better to exit and wait for the next major reversal setup. There's always going to be another trade. I remember back in the 1980s when I'd see something like this, I was afraid that every day would be like that forever and that I would never have opportunities to trade. That was a true fear. I really was afraid that the goose would stop laying golden eggs and the market would just enter a tight trading range and never have good patterns. There's always going to be good trades. There will always be several good trades every day. So never worry. It's boring to wait, but when the market is doing this, that's what you do, even if it means you do not take any more trades for the rest of the day. You should enter with stops. This green box is an entry here, one tick above the high of that bar. You should enter with stops. Use protective stops. I don't have it drawn in, but this is the start of the move, so you put the stop below the bottom of the move, and you look for a swing trade. A swing trade means typically at least a couple legs, 1, pullback 2, and here 3. And you're also looking for something to last an hour or two. Finally, you're looking for a trade where you can make about 40% of an average day's range. So if the average day is 50 points, 40% of that is 20 points. And that's been a fairly common thing in the E-mini lately here in 2023. A lot of the swings are 20 points. If a setup is not good enough, then wait. Should you buy above this bull bar? Well, it's following 5 or 6 bear bars, so that's not a good buy. Should you buy above this bull bar? Well, it's a big bull bar. You may be in the middle of a trading range and it's following 3 bear bars, so that's not a great buy. Here we do have a trading range and we're near the bottom of it, so you want to buy a reversal up. But when you have a bunch of bear bars, it's better to wait for some kind of a micro double bottom. And here we went down, we went up, and we went down again. And therefore you could buy above the neckline here or above a bull bar closing near its high there. And look for a trade that'll last at least an hour or two and have at least a couple legs up. This has one and then a minor leg. These are minor legs, but it did last for a couple hours or so. And never worry about missing the best entry or the first entry, because if the trade is going to last for 20 bars, there will be other entries. So yeah, these entries are further up than this, so you're risking more down to your stop. But you also have a higher probability of making money, and that's the price that you pay. The stop further away is the price that you pay to have a higher probability trade. So these are all very good entries. Missing the first few bars, if the trend is good, there'll be plenty of opportunity to make a lot of money. So if you don't take this outside down bar after this attempt at a wedge bottom, wait for another bar closing near its low, sell below that. Here we have an inside bar after 3 bear bars closing near the lows. That's a low one sell. You sell below that. Again, the stop is up here above the start of the move, and your risk is greater if you take the later entries, but the probability of making money is higher, and that offsets the risk. Perfect patterns are rare. You'll see them on websites and in books, but it took the person who created that chart hours to find a perfect pattern. If you wait for perfect patterns, you're never going to trade. It's better to look for something that looks similar to a good pattern. And the more it looks like a good pattern, the more it will behave like a good pattern. As I said, nothing is going to be perfect, but get good at recognizing all the variations. And that's one of the advantages of the encyclopedia. If you look in the section on wedge bottoms, I have maybe 50 or 100 examples. If you look at them, you'll see that most of them are not perfect, and that should give you confidence to take trades that look less than perfect. And if you're not all that certain about a trade, here we have a wedge. It's a bull flag because it's a higher low after a strong rally. If you don't want to take the buy above the consecutive inside bars, you can wait for a bull bar closing near its high. So now we have two bull bars, one with a big body closing near its high. That's a higher probability buy. Here we have two bull bars closing near their highs, closing above the moving average, and one of the bodies is completely above the moving average. That is a higher probability buy. I talk about all these little things in the encyclopedia. The encyclopedia has lots of little things like that. And you're not going to remember all of them, but the more that you learn, the more confidence that you'll have in taking trades. When you start out, you're always going to be losing money, and that's okay. But, don't be hard on yourself. The way I look at it is you have to be your own advocate and your own cheerleader. Everybody else's job is to find your faults and tell you all the things that you're doing wrong. Don't let the people get you down. Take your time, learn stuff, learn how to recognize patterns as they're forming. And when you see something forming, if you don't have a lot of experience with it, look for the pattern in the appropriate section in the encyclopedia, and then look for examples that are similar to what you see, and then bet that what follows today will be like what followed on those other days. Again, I'm Al Brooks, and I hope that you found this useful. This was an introduction on how to use my Brooks Encyclopedia of Chart Patterns.